Futures and derivatives trading is a sophisticated segment of the financial markets that enables traders and institutions to speculate on price movements, hedge against potential risks, and gain exposure to various asset classes without directly owning the underlying assets. A futures contract is a legally binding agreement between two parties to buy or sell a specific asset at a predetermined price on a specified future date. While derivatives are broader financial instruments whose value is derived from the performance of an underlying asset, such as stocks, commodities, currencies, interest rates, bonds, or cryptocurrencies. These instruments play a vital role in global financial markets by providing liquidity, improving price discovery, and helping businesses manage uncertainty caused by fluctuating market prices. For example, airlines use futures contracts to lock in fuel prices, farmers hedge crop prices before harvest, and manufacturers secure raw material costs to protect profit margins from unexpected price changes. In addition to commercial hedgers, futures and derivatives markets attract speculators who seek to profit from anticipated price movements by taking long positions when expecting prices to rise or short positions when predicting declines. One of the primary advantages of futures trading is leverage, which allows traders to control a large contract value by depositing only a small percentage of the total contract amount as margin. While leverage significantly increases potential returns, it also magnifies losses, making disciplined risk management essential for long-term success. Traders commonly employ stop-loss orders, position sizing, and predefined risk-reward ratios to minimize the financial impact of unfavorable market movements. Futures contracts are standardized and traded on regulated exchanges, ensuring transparency, liquidity, and efficient execution. Commonly traded futures include equity index futures, crude oil futures, gold futures, natural gas futures, agricultural commodities, government bonds, and major currency futures. Beyond futures, the derivatives market also includes options, swaps, and forward contracts, each serving different investment and risk management purposes. Options provide the right, but not the obligation, to buy or sell an asset at a predetermined price before expiration, while forwards are customized agreements traded over the counter between private parties. Swaps enable institutions to exchange cash flows or financial obligations, particularly in interest rate and currency risk management. Successful futures and derivatives trading requires a comprehensive understanding of market fundamentals, technical analysis, contract specifications, and macroeconomic events that influence asset prices. Traders frequently analyze support and resistance levels, moving averages, relative strength index, RSI, MACD, Bollinger Bands, volume indicators, and chart patterns to identify potential entry and exit points. At the same time, they closely monitor economic indicators such as inflation data, employment reports, central bank interest rate decisions, gross domestic product growth, geopolitical developments, and corporate earnings, because these factors often trigger significant price volatility across futures markets. Emotional discipline is equally important since fear, greed, and overconfidence can lead to impulsive decisions that undermine profitability. Developing a well-defined trading plan, maintaining realistic expectations, and consistently following established trading rules can help reduce emotional biases and improve long-term performance. It is also important to understand contract expiration dates, rollover procedures, settlement methods, and margin requirements before participating in futures markets. Beginners should consider practicing through paper trading or demo accounts before risking real capital, allowing them to gain experience with market behavior and trading platforms in a risk-free environment. Ultimately, futures and derivatives trading offers significant opportunities for hedging, speculation, portfolio diversification, and efficient capital utilization. But these opportunities come with equally significant risks that require education, discipline, continuous market analysis, and prudent risk management. By combining technical expertise, sound financial planning, and a structured trading approach, market participants can navigate the complexities of futures and derivatives markets more effectively while working toward consistent and sustainable trading success.